Hey everyone, this is Buck Joffrey here. We're doing a little bit of I wouldn't call it an emergency podcast, but I do think it's something that I just wanted to get out there sooner rather than later. As you may know, most people probably have exposure to the stock market, and stocks have taken a pretty significant beating the last couple of days, down about 10% or so. Now, it shouldn't actually come as a surprise because if you listen to my podcast a couple weeks ago, I talked a little bit about how Treasury Secretary Scott Bessent had essentially said, hey, we're going to move forward with this idea. We sort of don't care what happens with stocks. And what we do care is that it's going to probably drive down the 10-year Treasury, which it did for a period yesterday. It was under 4 for a brief period of time. That's good for mortgages and such. The idea was that basically, slow down the economy, refi debt, and then let assets, lose value if they need to, and potentially adjust. He calls it an adjustment period. So that's what you saw. Now, there's a few things here to point out. One is the S&P is down 10%. That's huge for the S&P, right? However, in Bitcoin, we call that Wednesday. It's not a big deal. So in cryptocurrency, it's not a big deal. Now, Bitcoin is down itself, probably about 30% from the top. And real estate is also down. And you've known that for a while now. Real estate's down 25% probably on average from multifamily. But now everybody who, there's a lot of noise out there because, now you're seeing it in stocks. And there's no question this is a big deal. And it's times like these where, you need to really think about deploying capital, moving on with some of your plans in terms of capital deployment. And so one of the things that it occurred to me is that this is a good time for anybody who's thinking about doing the Wealth Accelerator program that has been on the fence, who's been, kind of thinking about it, trying to maybe time it out or whatever. So based on that, I've got our friend Rod Zabriskie here. Rod, how you doing?
Hey, I'm great.
Yeah. So what do you think of what I just said? I mean, pretty. This is when people should be investing.
Sure, yeah. So the Wealth Accelerator is a strategy where we're using high cash value life insurance and more so indexed universal life. And the important thing about that is that indexed universal life is not invested in the stock market, but it's using the stock market, an index like the S&P 500, to determine how much interest you earn each year. So in years where the market is up, you participate in a portion of those gains up to a cap. And right now on the S&P, the cap's right around 10%. In years where the market goes down, you don't participate in the losses, but you just don't earn any interest. So you have a floor of 0, a cap of 10, and so it gives you that downside protection. You don't have to worry about participating in losses.
Well, and the upside really isn't just 10% because you're using leverage.
Exactly, right. So when we're building this, you put in the initial funds, that creates an asset, and then we're actually going to use that asset as leverage to go get a loan and use that loaned money to continue building the cash value in the policy so that most of the money going into it ends up coming through the leverage side. And now to Buck's point, if in the long run, that asset by itself would return me, say, around a 6 or 7% net return that's tax-free. So that matters. But by using the leverage, I can turn that into an 11, 12, 13% return. Again, that's tax-free.
And again, that's
really
just with
powerful.
6-7% returns. Now, if we're talking about a true potential here of, a big bounce back in a year, then you'd be working off of that cap, which is like 12%. And I imagine when you're leveraging that, you might be into high teens, low 20s at that point.
Sure.
Let's talk about that, though, because timing wise, this is one of the things that I thought was really important. When you have a crash like this, and I think this is probably a fair, reasonable event to call a crash. And I don't think it's over, by the way. I mean, who knows by the time, we'll get this out tomorrow, but by the time this happens, I mean, I still think there's a real, possibility of there being a continuous drop because you're going to have margin calls You're going to have stop orders going off and that kind of thing. And there is a legitimate fear in the air. And, the reality is that the Trump administration has said, hey, we're sticking to this. We're not going back, right? We're trying this. So anyway, the point is, when you have events like this, you did a little bit of research on what happens year over year, typically.
Yeah. So specifically, the research I was doing is when you have large 1 day drops
Mm-hmm.
in history, then what happens over the next year? So, and what I found was that if you go back to 1981, since that time, the 10 largest 1 day drops, 9 out of those 10 over the next year returned double digits, right?
Right.
So, and it's extreme. The worst 1 day drop in history of the S&P 500 was October 1987, where it dropped 20%.
Right.
And then over the course of that next year, there was a 12% increase above that. Most of them aren't that. The next highest one was like 8.9 or something, right? So that was an extreme
Yeah.
situation. But take the 8.9 in 2008,
I mean, what was
1 day drop.
I mean, we're down 10 now. Like one of the days didn't it beat that?
It was 4. The first day down was 4, and the second day down was 6
Oh,
plus.
okay. Got it. I
So
was thinking that second day, I thought it was more than that. But
yeah, but that
anyway,
puts it into this, like the ones I'm looking at in 1989, there was a 6.12% drop, and that's in the top 10
yeah.
since 1981. And so it puts it right in that ballpark.
Yeah, totally. And so I think timing wise, one of the things we're trying to get at here is there's lots of ways you should be deploying capital, right? Next week, our investor clubs will see some stuff on the real estate side. I mean, heck, you want to go in, throw some money in the S&P 500 right now or whatever, do that. But, the Wealth Accelerator thing that that Rod and Christian have been talking about, which I have, and I do think it's worth really looking into because it is a way of ultimately, investing in this market with guardrails. You get an amplification of the upside, which essentially means you don't really lose out because that cap is leverage. So typically you're going to make it as much as the market is or more. And then the downside really is protected. And I think it's a great vehicle for that purpose. And, the bottom line is that if you're going to deploy capital anywhere, whether it's, any of these things that we talk about, I really encourage you to start thinking about doing so in the next couple weeks. Now, Rod, when somebody hasn't started something like this, how long is that process?
Yeah, so we go through an underwriting application process with an insurance company. So I tell people to plan on, at least 2 to 3 weeks to get that completed before they're ready to deploy and put the money in. Sometimes it's a little bit longer, but that's realistic.
Yeah, but I think at the end of the day, we are, I think, going to be dealing with a down market for a bit. It's be something that we're going to experience. It's not going to be just for a few days here. So anyway, Rod, thanks for joining. Is there anything else we should talk about? I mean, certainly you can contact Rod at wealthformulabanking.com and through the contact there. What else?
Yeah.
Is there anything else we should be thinking about, Rod?
I mean, the big thing is that we custom build these for each individual. So you just say, hey, this is kind of what I'm bringing to the table. This is what I'm trying to accomplish. And the real goal in this is to create tax-free income for retirement. And
Right.
or a lot of people are using this strategy, the leverage, to produce higher estate planning values coming off of their life insurance as well.
Yeah.
So it can be either or both of those. You don't necessarily have to decide today which you're going to do. You decide later if you want to take the income. If you don't, then it just means your estate's a lot bigger when you pass.
I mean, listen, it's a great option. Again, my point here is to just say, hey guys, get off the couch, pull the trigger, start, or at least get your stuff together and really start thinking about deploying, because this is what we wait for, right? In real estate, it was less obvious to the world that we were still already 25% down, but we've been there and we are still there. Bitcoin's down 30%. This is a rock solid type of structure that I really like. That's, anybody who's done any of these insurance products through Rod and Christian has I don't know anybody who's just been disappointed. It is, if anything, I just hear people wishing they did more. That's it. So anyway, go to wealthformulabanking.com to reach out to Rod. Rod, thanks for joining for this little, I don't know what you want to call it, a little episode, a little bit of reminder, a little bit of a kick in the butt, whatever it is.
Glad to be here. Thanks so
All
much.
right.